Years of working with taxpayers taught me a very painful lesson. Honest, careful people in their 60s and 70s bleed money quietly. They pay at least five major bills every year that they do not owe. And it isn't because they are reckless with their retirement funds. It is simply because nobody ever told them they could stop. Let's clear up the single biggest misunderstanding right away. This isn't just a basic list for low income seniors scraping by, and it isn't some complex wealth loophole built only for the rich. Whether you live on Social Security or a massive nest egg, this hits you. The systems collecting your cash have a direct incentive to stay quiet. Your county won't call to remind you to freeze your property taxes. Your government won't automatically stop tax withholding from your check. Many breaks are not automatic. You only get them when you claim them. Let's start with the absolute heaviest burden, your federal income tax. For millions of seniors, your future tax bill should be far lower. In fact, for many of you watching this, it should be exactly zero. A major tax provision introduced a powerful tool called the Senior Bonus Deduction. Starting in the 2025 tax year, filed in 2026, the rules changed. If you are 65 or older, you qualify for an extra deduction of up to $6,000. For a married couple where both are 65 or older, that is a massive $12,000. This isn't a complex itemized deduction you have to fight for. It simply stacks cleanly on top of your standard deduction automatically. If you live mostly on Social Security, this can wipe out your income tax completely. If you are middle class, it provides full relief for singles making up to $75,000. Married couples get the full deduction with income up to $150,000. It phases out entirely past $175,000 for singles and $250,000 for couples. But there is a catch. This powerful bonus is completely temporary. As it stands, it only applies to 20, 25, 20, 26, 20, 27, and 2028. You must claim this asset every single year before the window closes. That leads directly to the second major issue, the tax on your benefits. People often think Social Security is either always taxed or never taxed. Both of those common assumptions are completely wrong. It depends entirely on a metric called your provisional income. That is your non Social Security income plus half of your benefits. If you are single and under $25,000, your benefits are 0% taxable. For married couples, that tax free threshold sits at $32,000. Even at the highest income tiers, 15% of your benefits remain tax free. But here is the real mistake I see people make out of pure fear. When filling out their forms, they check the box for the W-4V. They tell the government to withhold federal tax from every single check. They give the Treasury an interest free loan on money they may not even owe. Look at your real numbers and right size or stop that withholding entirely. Pay what you owe on time, but do not give the government a free gift. The third bill that makes people incredibly angry is property tax. Seniors often assume they don't qualify for relief, but they do. There are generally three different tiers of property tax assistance. The first is income based, which can dramatically lower bills for fixed incomes. The second is a flat senior exemption that knocks value off the top. The third is the one comfortable retirees miss, an age based freeze. Take Texas, for example, where school property taxes freeze at age 65. In some cases, your taxable school bill can stay capped, even as values rise. There is zero income limit on this specific type of relief. But your county will not automatically apply this when you turn 65. You have to actively file, and missing the deadline means losing out. Call your local county assessor and ask what age based freezes exist. The fourth area is Medicare premiums, where two overpayments hide. First, Medicare Part A should cost you exactly $0 in premiums. As long as you worked and paid into the system for 10 years, it's free. That work history requirement translates exactly to 40 quarters. The second overpayment hits comfortable retirees, and it is called IRMAA. This is a heavy premium surcharge that kicks in at higher income tiers. The trap is that Medicare looks at your tax return from 2 years ago. If you recently retired, your income may have completely fallen off a cliff. Yet you are stuck paying a surcharge based on money you no longer make. You can fix this by filing a specific document called Form SA-44. Retirement is legally classified as a life-changing event. Filing that form forces them to recalculate based on your current reality. The fifth bill is the literal fee you pay to manage all the others. Every year, millions of seniors hand storefront chains $200 to $500. They pay this just to file a very straightforward retirement return. If your return is simple, you likely qualify to get it done for free. The IRS funds a certified program called tax counseling for the elderly. The largest provider is AARP Tax-Aide, and you do not need to be a member. They specialize in pensions, Social Security, and required withdrawals. Now, if your situation involves complex estates or rentals, hire a pro. A great professional is worth every single dollar in complex cases. But if your return is basic, paying a chain hundreds is a waste. Now, if you have built up some real wealth, these next three moves are vital. The first involves the underlying fear of selling your long term home. People stay in houses that are too big because they fear a massive tax bill. But the home sale exclusion rule protects your hard earned equity. If it was your primary home for 2 of the last 5 years, you get a break. Singles can exclude up to $250,000 of pure profit from their taxes. Married couples filing jointly can exclude up to $500,000 of gain. Remember, that is profit, not the total final sale price. The second wealth move is the beautiful 0% capital gains bracket. When your taxable income drops low enough, long-term gains face zero federal tax. In 2025, married couples can have taxable income up to roughly $96,700 and pay 0%. For single filers, that 0% tax-free line sits at roughly $48,000. Smart retirees harvest these gains on purpose during low-income years. The final bonus move is for anyone 70 and a half or older with a traditional IRA. If you give to charity, do not write a check from your bank account. Use a strategy called a Qualified Charitable Distribution, or QCD. You can send up to $108,000 a year directly from your IRA to a qualified charity. That money is completely excluded from your taxable income. Since most retirees take the standard deduction, regular donations give no tax break. The QCD bypasses this entirely by lowering your adjusted gross income. A lower income number reduces your Social Security tax and Medicare premiums. Once you hit the age for required minimum distributions, the QCD counts toward it. It is the cleanest way to support a cause without giving the state a cut. Let's tie this together. Every rule I just mentioned is already on the books. The senior deduction, the property tax freezes, the IRMAA appeals. They are all completely real, but not a single one is automatic. The system is designed to keep your money unless you stand up and claim it. The struggling senior assumes the good programs are only for the wealthy. The comfortable senior assumes the relief is only for those scraping by. Both groups end up overpaying out of sheer assumption. That is the invisible leak I want to help you stop today. I made a simple checklist you can review before tax season. It covers every major break, the exact forms to use, and the deadlines to watch. You can find it in the description if you want to go deeper. Do me one favor, share this math with a friend or neighbor over 65. One simple share could save someone you care about thousands of dollars. Take action on these rules, and I will see you in the next video.